Hey, this is Sasha. Welcome to another episode on Hungry for Returns. Today we're going to take a look at single put, single calls. We have a question from Travis, and gives you a little bit of a twist for some some thinking here. All right, so take a listen, and we'll go to the screen here in a second.
Hello, Sasha. My name is Travis. Thank you for the video that I've received through YouTube of you talking about puts, which I was kind of confused about. I've learned from your video that there's two more ways to make a potential profit, being just a seller or a loan versus being a buyer then a seller. I've been taught that when you're looking for a call, of course, you buy at support. You want to sell at resistance. And when you're looking for a put, you want to buy at resistance and follow it down to support to make the money. When buying a put, I guess my problem is adding the potential percentage profit to it and setting a stop limit to it. So my question is, in reference to writing the put, how do you add your potential profit percentages, which give you a different price for the put to reach in order or before you sell? I hope the question is not confusing, but I thank you for allowing me to submit a question.
All right, so let's go to the screen here. I just want to share with you some insight. Really big picture concept. Most people, this has to go to the full face. Most people trading single puts, single calls is not the right approach, especially on the buying side. When you buy something as a single put or single call, you're losing money on the theta decay. So it's very important you understand that this is a classic mistake for most people starting out with trading options, is that they're trading it the wrong way. The better, smarter approach is to do spread so you can make money from the time decay and theta. So if we go from our screen, and just to show you that same Amazon trade I put on a while back, you can see this one, even though it's going outside my range over here, we're basically still profitable about $136, even with the market downturn that we've really had. So this is kind of the market movement we've had, and we're still profitable. That's how you make money in options. That's the better, smarter approach. Now, when you're looking at single calls and single puts, let's just take, for example, a Facebook here. If you're looking at, buying support, buying resistance, buying at support, selling at resistance, I mean, you're basically trading stock in the same kind of way, or you're trading options in the same way that you would trade stock. So here, if you're looking at Facebook, and let's just kind of go to, maybe you're looking at the daily, I don't know, but let's say you're here at 160, so you would probably want to buy a call here, and if you're buying a put, you probably buy a put somewhere up high, and then you make profit on the way down. So that's kind of a typical approach, but the problem with that is when you're trading single options, they're kind of like dead fish. They start to rot very quickly because you're losing money very quickly. So what you want to do is either go further out, you want to kind of minimize that theta decay, maybe do a vertical, that kind of slows things down a little bit. It's just a better approach. So the big point I want to make from this thought of this question is that rather than going out, 38 days just to show you, if I think, okay, Facebook's going to bounce, let's say I buy a single right here, watch the problem that we have. Our problem is we lose $6, $7 every day. If I did the similar thing with a put, you lose about $5, $6 a day. So you're losing. If I turn this into a vertical, which, by the way, you would go ahead and you could just right click and buy a vertical, or you could, buy protection, just one strike down. You could buy one in the money if you wanted. So here we are buying one, and let's say we are selling one. So here I have a vertical this way. I could go ahead and sell one, at different prices, and that'll change my vertical around, right? So now I have a vertical that's to the upside. So if you're looking for it to move higher, I could do something like this. And now all of a sudden that theta decay gets cut a little bit. I could go ahead and move this around a bit. So let's say the current price is 180. I could bring the one I'm buying right at the money, the one I'm selling around 190. And now again, my theta is way less than it was before. I also use a lot less capital than before. So that's kind of the smarter approach. I think as far as buying at support, you know, letting it bounce and going to resistance, you know, you're constantly guessing and taking chances, which, you know, statistically, as you get better at it, it should pan out and work out. But if you're trading options and you already know and understand options, then there's better ways to do that. That's the thing, and the power behind options is that you don't have to have a guessing game of where the stock's going to go. You could set up spreads to where they're non-directional. But if you're doing singles, it's kind of it's a losing bet on a day-to-day. You need that stock to move, and you need it to move very quickly to offset the time decay. Otherwise, take a look at this: $8 losing per day to 9, and then if you set it up as a vertical, you're only losing 1 to 2. So that's a smarter approach to doing it. As far as taking profits, you know, yeah, you could set it up. There's so many strategies. You could set it up to where, okay, well, if I get a bounce at the 160, I get into my single or vertical, and then I slowly take profits off into strength. Percentage-wise, that's just a matter of how good you are with it, how much risk you want to take on. You know, some people are more risky than others. Some people start with 5 contracts, and then with time they take off 1, they take off 1, they take off 1, they take off 1 until they're fully out of their position. So that's just a matter of perspective of your strategy, risk tolerance strategy. But the big thing here to know and understand is that doing singles, it's a good starting point, but it's not the right approach to trading options. Eventually, you'll probably want to get into something more like verticals if you're doing directional. Even then, there might be better approaches with like butterflies, calendars, calendar trades at least can do non-directional things like I showed you here with Amazon, which is not as much of a moneymaker as I had the other week when I showed this, but still, you know, making what, $130 here on the account. Yeah, 120, not a bad deal. Coca-Cola up 3.35. So anyways, a lot better in that regards to do something more like this because, hey, you're not worried about where the stock moves. And you could set these up a little more bullish. You could set them up a little more bearish and still making money and profit. That's where you want to get to with options. That's the smarter approach. Of course, you could do singles. You could buy a single put, single call. You could sell a single. You could sell a single put, sell a single call. There's 4 parts to those, right? 4 areas: buying, buy a put, buy a call; selling, sell a put, sell a call. And a combination now, all of a sudden, you have so many variations and choices and very creative strategies that you can get to. So don't think too linearly about it and look at the bigger picture. Where do you want to go? What's possible? And what's the next level? And this is where you want to get to, at least at the next stage if you're at the singles. So anyway, I hope that makes sense. I know it's not an exact answer to your direct question, but that's the answer you need to hear. So thank you so much for sticking with me. If you have a specific question you want me to answer, go to the website, submit a question. You can speak it, makes it a lot easier. And also don't forget to subscribe on YouTube. Thanks again for joining me, and I'll see you next time.